Welcome to the Daily Update, Condensed Edition, where I'll go over the action in the market for Thursday, July 6th, and then we'll see how things look for Friday, July 7th. I probably sound different. I had to do this for the full-length video too. I have a pretty busy schedule right before I do this video, and so I have to record it in a little different way, and I'm not able to do a lot of editing like I usually do. So you're going to hear me trip over a few words and stumble and make some mistakes along the way, but hopefully I can convey the important things to you nonetheless. So let's go back and talk about what happened. We did have a pretty significant down day, but it actually looks a little worse than it really is. We're still maintaining more of a positive posture, but when we look at the chart, you'll notice that we were able to fill the gap from last Thursday to Friday. We found some support and then spent the rest of the day coming back. What are some comments that we can make? Rising interest rates were really the big concern. They rose really on Wednesday and then on Thursday, and that put a lot of pressure on stocks even before the market opened. Then on a short-term basis, we only have our stochastics that are giving us some extreme positive readings. The whole list that I talked about yesterday, that's pretty much been cleared off now. On an intermediate term basis, we're keeping an eye on our oscillators. They're still looking a little toppy. Some of them want to turn down. Some of them are going a little bit more flat. If we have more of a follow through to the upside, we might see them turn back more positive. We're also keeping an eye on the rate of change going back 200 periods, and we're looking at that on a more intermediate term basis. The dollar was down and interest rates ended up being higher, and we've seen 2 days back to back now where interest rates really went up, and that started to spook the markets. All of the yield curves that we follow remain inverted. Sentiment is still extreme positive. It ticked down slightly, but it's still at a pretty extreme reading at 79. Our trend is positive, but the green line is coming down and the ADX is starting to drop below the moving average, but they're still both above 20. Our bias is now negative and our momentum is mixed to negative. The reports that came out, we had the weekly MBA mortgage applications index. It was down 4.4%. Purchase applications were down 5%. Refinance applications were down 4%. We had the ADP employment change. There was a real big increase in private sector hiring, where it came in at 497,000, much more than the 245,000 they had expected. Last time we had the report, it came in at 267,000. Weekly jobless claims did go up a little bit more than expected, but they're coming down overall at 248,000. Continuing jobless claims are at 1.72 million. That's also declining. We also had the trade balance report. It came in down 69 billion, which is what they had expected, or minus 69 billion. A little bit better than the minus 74.4 billion that we saw last time. The final IHS Market Services PMI, it's above 50. It came in at 54.4, a little bit weaker than the last time we had this report at 54.9. The JOLTS job openings also decreased to 9.824 million, where it had been at 10.32 million. And the big one was the ISM non-manufacturing. It's above 50. It is showing some slight expansion in the economy. It came in at 53.9, more than the 51.1 they had expected, and up from the 50.3 that we saw last time. Here's the intraday chart where we really gapped lower. Now, we hit S3 and S4, which we usually don't hit. That's because these levels are calculated based on the previous day's action, and being around the holiday, there wasn't an awful lot of market movement. And so to get to these levels didn't really take all that much. If you look at how we dropped, we went back and actually filled the gap from last Thursday into Friday. We were able to find some support and then spent the rest of the day bouncing back, and we ended up closing at S3. Here's the chart that we're also watching. This is the correlation between the VIX and the S&P. We're starting to go above this dashed line. This typically is negative, but there have also been times when we get a high reading when it can be positive as well. We'll just have to look at the context as we keep going up with this overall correlation to see if it's really telling us something. We're also watching the SKU index, which it didn't quite get up to this extreme positive area, but now it's starting to come back down. Again, we don't really know. Is this going to produce some kind of a top pattern or a bottom pattern or a continuation pattern? We have to look at the context of our other charts. As far as our trend, we are dropping below the moving average with the ADX. The green line is on top, but it is declining. However, both the moving average and the ADX are still above 20. Here's the daily chart showing how we went back and filled the gap from last Thursday. So far, support is holding. What's going to be critical right now is the employment situation report is going to come out. If that really spooks the markets and we start to fall, is support going to hold? If it is taken more friendly, that may produce some real support for the market and start to push prices back up higher. You can see on the bottom where we did show an increase in volume, but we're still below average. We're also bringing up the chart of the moving average tree, showing how we're not quite down to the 20-period moving average yet. That's considered a short-term moving average, and as long as we stay above that, we can just judge this as a pullback. Now, if we break below that, then that changes the context. Then this is another area we're keeping an eye on. The transports, they came right up to this previous high and are starting to turn down. Are they going to continue to go down, or are they going to find some support and turn and go back up? We saw a little bit of a decrease in the utilities as well after coming back above this downward sloping trend line. Then we're looking at the transports to S&P 500 ratio. In a good solid environment, we want to see this ratio going up. It actually ticked down. Then looking at the relationship between the S&P and the transports, didn't really change all that much, but they are coming more in line with each other. We're also keeping an eye on the 61.8% retracement level as overhead resistance. Can the NASDAQ break above that, or are we going to fall back even lower? And then the NASDAQ 100 is also dealing with a previous high. We came up to this level and have been falling back. Are we going to get some support and break through, or are we going to keep falling? Right now, we're still above this pivot level, so support is holding. This is where we saw a lot of the spookiness that came into the market. On Wednesday, interest rates really went up, and they really went up even more on Thursday with the 10-year bond yield. And when that happens, price really goes down. Based on the ETF, we've dropped below the 200-day moving average, and we've been really dropping as far as price is concerned. The RSI for the bond ETF continues to be negative, and the MACD is also turning negative. So what's our outlook for Friday? We're still positive right now, but if we see more follow-through selling, that could switch us over to a more negative stance. We have the employment situation report coming out. That's the most important economic report of the month. How is the market going to react to that? And then the whole list of geopolitical events, keeping an eye on Russia and Belarus and all of that mess and seeing if it will have any impact on the market. Right now, the markets are really concerned about inflation and interest rates and growth concerns. A few days ago, it was looking more Goldilocks, that everything was just right. Now the market's starting to get a little bit more nervous about that. Here's the updated calendar for the economic reports that are coming out, where we still have the employment situation report due out on Friday. Our stock traders almanac statistics, we're neutral to positive with the Dow and S&P, where with the NASDAQ, we're actually more positive historically. We'll be on the fourth trading day of the month, where we do see some strength during a pre-election year, before we start to head into some choppiness and then eventually into historical weakness. And then we're keeping an eye on this too with the NASDAQ, where it tends to perform well up until the middle part of July. So our scenarios, hard to go with the down one yet. Even with the down day, we are still positive, but we're going to turn more negative if we see more selling. It's hard to go with the up one unless the market really reacts positively to the employment situation report and we start to pick up some lost ground. But we definitely can't go with the neutral trend right now, because even though our ADX is declining and it's below its moving average, both of them are still above 20. So our warning signs, the VIX is still showing a lot of complacency and it's acting kind of strange, which is why we're looking at that other chart of the ratio between the S&P and the VIX. The cumulative new highs and new lows for the NASDAQ continue to show weakness. The 3-month yield is still above the level where it was at back in 2007 before the great financial crisis happened. And then earnings season, any reports will be taken either positive or negative. On the positive side, we still have the seasonality and setups that are in the background that apply longer term, and they're still there. The special K on the daily chart is positive. On the weekly chart, it's negative. The long-term equity put call ratio is still positive. The S&P is still above a downtrend channel upper line that I haven't been showing. If we continue to fall, I'll probably bring that chart back up. We're still in a risk-on posture favoring stocks over bonds. The transports are improving, but they hit that resistance, and now we're going to have to see, are they going to turn down, or are they going to be able to get some support and go back up? Lower price levels so far have been providing support. If we see some weakness, are those support levels going to hold? The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, we're keeping a close eye on them. The NASDAQ at that 61.8% retracement level, and then the NASDAQ 100 at the previous high. If we can get above those and then close above those levels, that would be quite positive for the market. The Staples to S&P 500 ratio is declining. The small cap, based on the Russell Index, has given us a golden cross, where the mid caps also generated a recent golden cross. Small cap and mid cap growth is still positive when compared to value. So our conclusion, the S&P, it could be turning negative if we see more selling. It could switch back and go more positive if we have a good solid up day. On a short-term basis, we may be turning more negative and we're no longer overbought. Intermediate term, we also could be turning more negative unless we see some real positive action in Friday's session. Long term, though, we still remain positive as long as we're above the 200-day simple moving average. Thank you. I hope you found this helpful. Please feel free to check out the full-length video if you want a more in-depth analysis of what's happening. Have a great day, and I will talk to you in the next video.